right. Hello, everyone. Thanks for taking the time to join us today. I'm Johnny Antos, and I'm an associate at Prysm Group. I'm also joined by two panelists who I'll have introduce themselves momentarily. But first, today, we're here to explore and discuss the security of decentralized finance, focusing on the intersection of the technical and economic elements to drive security. It's a particularly important question as the space is really active right now. First, looking at the agenda, I'll give a brief overview of DeFi, how far it's come, and also take a look at some prior hacks. Then I'll talk about the ways that we've seen economics specifically play a role in some of these incidents. After that, we'll dive into discussion with both panelists and finally wrap up with some audience Q&A. So like I said, I'm joined by Dan Guido, CEO at Trail of Bits, and Calvin Liu, the strategy lead at Compound. Starting with Dan, do you guys want to give some brief background on what your company does?
Yeah, sure. So I'm Dan Guido, CEO and co-founder of Trail of Bits. We're a software security research and development firm that was founded about 8 years ago to focus on fundamental problems in computer science and computer security. So we work with people across the defense, tech, and finance space to help them build secure products, and sometimes we build them for them. A lot of what we do is applied research. We release a lot of academic research papers. We're very engineering driven, so you'll find us also developing a lot of code. And we have an extraordinarily competent team of blockchain security engineers, which has led us to work with Prysm Group and Compound and a lot of other major players in the space.
Awesome. How about you, Kevin?
I'm Calvin. I'm the strategy lead at Compound, been there since basically the very beginning, 2.5 years ago. As the strategy lead, I focus on pretty much everything that is business related. It's sort of a wide bucket of things from over the past 2.5 years, fundraising to biz ops to product strategy, to sort of dealing with all the funds and exchanges and custodians and whales that are interested in using Compound. What Compound is an interest rate protocol that's built on Ethereum. It's a decentralized interest rate protocol for users to supply ERC20 assets or Ether and earn interest, and for other users to come borrow those assets. The governance token was launched actually less than 2 weeks ago, where the governance of the protocol has been turned over to comp token holders as well.
Yeah, that's really exciting. Yeah, I'm definitely looking forward to the discussion that will take place shortly. But first, getting the presentation, getting right into it to set the stage. DeFi has been a hot topic over the past year, and there's kind of the sentiment in the blockchain and crypto communities that DeFi might be the vehicle that crypto goes mainstream. People kind of wondering, is it here to stay? Is it a flash in the pan, sort of like the token boom in late 2017? And even if it does find product market fit, is DeFi sustainable in the long term? These are some of the questions that are sort of swirling around. For those new to DeFi, looking at what it really means, it's a fairly broad term, and there's no real hard demarcation between projects. All DeFi projects tend to have the ethos of composability, and an analogy is often made to Legos in terms of kind of their plug and play nature. It's also worth noting that kind of in contrast to Bitcoin, all DeFi projects, or at least ones with sort of sizable economic value, are birthed by VC-backed companies that aim to create a more decentralized system over the life cycle of the protocol. So looking at the ecosystem map, when you dive into DeFi, the first thing you really notice is the incredible diversity in the subcategories. The common thread is that all DeFi projects are, like I said, in some manner trying to disintermediate a specific slice of the traditional financial system, whether it's kind of lending or derivatives or exchanges being kind of the three core most popular. In this map, you can see I have decentralized exchanges on the far left, some centralized exchanges there too, credit and lending above that. Wallets is also there. And then at the top, there's this sort of interface layer. Things like InstaDApp and Zerion allow people to sort of interact with different protocols without having to go into their specific interfaces. It's also notable that Under a more narrow definition of DeFi, if you look at the total locked value in DeFi protocols, it's really completely Ethereum based. And it's true that there are earlier stage DeFi projects on other blockchains, but it's really the Ethereum game right now if you're talking about protocols with significant economic value stored. Next, looking at these charts, as I'm sure many of you know firsthand, if you work with DeFi projects or you develop a protocol, you kind of get the strong sense that they're all interconnected in some way. So not only are there a plethora of different protocols, but really in the middle of 2019 there in the middle chart, we start seeing more interconnectivity across DeFi to the point where now you have this web on the far right that has a few major bilateral channels, but it's definitely much more complex than say, late 2018 on the far left there. And this picture says a lot, and I find it really compelling. So looking at some of the incidents that have occurred in DeFi, the good news is that over time, the total value locked in DeFi is going up and is actually even higher than shown here. This is sort of pre-compound launch. And now this, I believe, is about even 1.5 billion. So this orange line is way up here now. The bad news is, though, that in conjunction with this increase in economic value, we've seen a plethora of hacks, and not only has the number of hacks increased in the first half of 2020, but also the dollar value that's compromised in those hacks has also increased. So what do we mean by hack here? A hack is any vulnerability or exploit, either technical or economic, where certain agents are able to cause any degree of economic damage. So this could be other user funds, or it could be an agent manipulating the protocol in a manner that artificially benefits the attacker. I'll touch on a few of these specifically later. Note that it's a total of about $50 million in the analysis when I added these up, which at the time when if DeFi's total locked value is about $1 billion in USD, that's around 5% or so. And yeah, like I said, I'll touch on a few of these later, but they really did accelerate in the first half of 2020, particularly after, I think shortly before the BZX hack there in February 2020 is when the total DeFi market cap hit $1 billion for the first time. It's also interesting to look at this on an ETH basis. The previous chart was on a USD basis to remove unrelated ETH price changes that may skew the level of real DeFi usage. It does appear that in this chart, post BZX and post the Maker incident, there's a general drop in ETH denominated total DeFi locked value, in part in conjunction with those incidents. And I guess another point on this kind of a set of incidents is that these were not purely from a technical angle where it was not just a bug in a smart contract where something went wrong. Oftentimes that very much was the case, but many of them were also driven by economic breakdowns in some manner. And we find that really compelling looking at it. We'll talk about that later in a bit. Double clicking on the chart that I just had up, it turns out that being hacked has bad consequences for systems. This is obviously an intuitive insight maybe, but if you look at the 1 day, 1 month, and I looked up until about June 18th, a little over a week ago, post-hack impact for each of these protocols, there kind of appears to be a significant negative impact of hacks at the protocol level. Note that Synthetics was in mid-2019, so it sort of occurred much earlier than many other incidents, which is partly why it's in the green and has had some time to recover. Another way of representing this data, and to wrap up this section, I was curious about whether the response to a hack within a given protocol is in line with the actual percent of value that's compromised in the incident. So though there are relatively few data points here, we see that on the BZX and Maker instance, the market response is sort of in excess of the actual value that was compromised in the incident itself. So this, to me, implies that there's a real decrease in trust in the protocol post-hack. Put another way, if users didn't care about a protocol being compromised, then you might expect to see that these points would be along the dotted line there. And these two on the far right are where both 100% of the value was compromised, and so by definition, 100% of the value was gone afterwards. Okay, now in the next section, switching gears, let's transition to the role of economics and potentially preventing these incidents. Many DeFi teams realize that they need security audits because it's necessary to have a third-party test the smart contract code to make sure that nothing is breaking. That's certainly true. However, there have been far fewer audits of the economic elements where economic experts dig in and are really testing the fundamental economic design to identify and fix issues with incentives in DeFi protocols. The way to stress test the economics of a DeFi protocol is not just to launch it and kind of see how things go, as the consequences of doing that can be disastrous. The high level takeaway is really that DeFi protocols have to get both the economics and the technical elements correct. And both of these elements, as we saw in the kind of interconnectivity chart previously, both the economic and technical elements are extremely linked and intertwined. So it's obviously something that's very difficult to get right 100% of the time, but key risks can be mitigated for sure. So in short, these are some economic heuristics or areas where across the hacks that have occurred, we've seen DeFi protocols most often make missteps. The first one is because of the interdependencies, if you recall that DeFi web again. Events on one protocol directly affect and influence events on and token values on other protocols. So that's definitely something that's not present in the traditional financial world, and it's very unique to DeFi. Next, we also noticed that in practice, DeFi auction design is particularly hard to get right. And auctions that are not well structured can really exacerbate a system's breakdown. Also, I'm sure many are familiar with what oracles are, and it's from a technical standpoint, the breakdown of oracles is very well studied, and there's a lot of literature on that. But oracles can also present a lot of economic issues, as individual agents can have incentives to report the wrong truth, and then if the protocol is able to be convinced of that value, that can obviously wreak havoc. And lastly, DeFi protocols have many different models for governance, or how the protocol kind of changes and policies are decided upon and implemented. Especially in the early days when teams are in the midst of transitioning to become more decentralized, it can be tough to determine how to implement the big red stop button in a way that balances control between communities and core teams. These are most easily understood in specific contexts, which I will jump into now. So looking at the Maker incident, also known as Black Thursday, many are likely familiar with this incident, but at a high level, the sharp drop in price in ETH led to a myriad of issues on Maker that became very apparent in this 1 to 2 day period. The first two threats, the economic interdependencies, as well as the auction design or auction failure, both played out in this incident, as well as, I guess, a bit of the Oracle too, if you see on the third bullet point there. And the first, I guess, one played out in that when the price of ETH tanked, it had a direct impact on Maker's protocol and triggered many liquidations. And so MakerDAO, the impact on MakerDAO was a direct result of what happened in the price of ETH. Next, then the auction breakdown piece comes in when their situation occurred where only 2 bidders were bidding for a bunch of liquidated collateral that all liquidated within a very short time period. And these 2 bidders keep winning a sizable amount of value, roughly $8 million for free with 0 bids, because there was no reservation price, and there was no reservation price or minimum bid embedded in the Maker protocol. So at the bottom there in the impact, you can see that clearly it developed into a tough situation. It's still ongoing and still being resolved. Next, there's an incident called Unpegnate, which this is a good example of the third economic threat, the idea that oracles can be easily manipulated if they're not designed properly. Pegnet is a stablecoin protocol that depends on miners to report accurate prices to oracles for each of their stablecoin markets. And what happened was essentially 4 miners were able to convert about $11 of USD. That's literally like about $10 or $11 of USD into $6.7 million of USD by querying to submit the same faulty price report to the Pegnet oracle. The only real saving grace was that there wasn't enough liquidity for the attackers to successfully exit, and they actually later claimed it was a security test, so sort of a strange resolution. And then the last specific incident we'll talk about is intriguing in part because it raises the issue of at what level in the DeFi stack responsibility should be assigned when something goes wrong at a specific protocol. As many protocols were involved in this, that's why I called it the DeForest LendFme IMBTC incident. DeForest operated the LendFme protocol, which is functionally very similar to Compound. And there, you may have seen the news, there were some allegations that they copied Compound's code. And DeForest implemented IMBTC on LendFme itself, IMBTC being an ERC777 token as a collateral source on LendFme, but IMBTC was vulnerable to a very old attack vector, a reentrancy attack, which many people might be aware of. And the key thing on the governance side here is that as this was occurring, DeForest didn't really have any tangible emergency shutdown procedures in place, even though their governance wasn't a decentralized model. So it was not spread out, sort of like how Calvin alluded to Compound's transition. They had complete control of this, but it still took them about 4 hours between when they first learned of the incident to when they actually paused on-chain deposits. And if they had acted sooner, then they may have saved user funds. This one also had a strange resolution in that the hacker apparently revealed their identity and then refunded DeForest 90%, and DeForest ended up making users whole. But even though the money was returned, negotiating with your hacker is not exactly where you want to be as a core team, especially at any point in your life cycle. And to conclude, I think another major issue that kind of plagues DeFi is the lack of transparency into key economic elements. Projects and investors need real economic insight for data to be meaningful and to make decisions. With Flipside Crypto, Prysm Group has developed a really amazing dashboard capability to track insightful economic metrics. For example, from a DeFi standpoint, it would be very useful to know certain measures of decentralization for various sides of, say, a DeFi lending market. And it could be that in a DeFi lending market, the borrowers are extremely concentrated, but lenders are extremely dispersed. And tracking that over time might be something that could influence how the team wants to prioritize new policies and system changes. And especially in a similar sense, especially as governance becomes more community run as DeFi further matures, measuring the degree of concentration in governance is clearly very important. But if you want to hear more about that, directly reach out to either me or Reed as well, who on the Prysm Group side, who helped put this together. But yeah, now without further ado, we will move to the moderated Q&A segment. I'll end the screen share. And yeah, getting into the questions, this is to both Calvin and Dan. How would you define decentralization in the DeFi context? Or how, put another way, how do you know if a DeFi protocol is decentralized? We can start with you, Calvin.
Yeah, thanks for that great presentation. It's a great recap of a lot of really interesting events over the past year or so. For us, we have been working on Compound for almost 3 years. Since the beginning, we thought about decentralization as like a core principle of what we were building. I think as of the beginning of last week, we think that the transition to full decentralization has really happened in a major way with the launch of the Comp token. But since the beginning, the way that we described it is basically if the Compound Labs Incorporated team got hit by a bus or just vanished or retired to an island somewhere, that the protocol would still function as intended as long as Ethereum continued to function, basically. So that's sort of like the, I think, simplest way to think about it. I think in terms of like mechanics of the protocol and decentralization, you really covered a lot of them in your presentation. I think it boils down to governance, like who gets to decide about upgrades to the protocol and what happens in terms of maintenance of the protocol. And then also in the Oracle, you don't want the protocol to rely on a single or very few Oracle sources for prices. But yeah, at a high level, it'd be basically that the team that created the protocol can vanish and it would continue to function as intended with no disruptions.
Yeah, interesting. How about you, Dan?
Yeah, I think Calvin's description is great. I'll just add that, from a high level, that's definitely what the goal looks like. I think at the low level, it's the question of, are there privileged operators and what can they do to the system? Sometimes those privileged operators are actual users. And at a very low level, you can use tools like Slither to programmatically identify capabilities of certain people to interact with the DeFi systems that are currently out there. So kind of a fun exercise for people that are maybe watching right now would be to run through every single self-identified DeFi app with Slither and see just what level of decentralization they actually have.
Yeah. You're saying if any single agent can control many elements, right, of how the protocol changes?
Yeah, I mean, tuning parameters, pausing the contract, whitelisting certain features or certain external interactions, fail safes, like these are all kind of elements of what decentralization is or what it means.
Cool. Yeah, yeah.
Yeah, that's actually a really good point to think about. Basically, like the influence users can have as well, especially as like the comp token sort of starts to roll out. If like what a single user were able to accumulate a large amount of it, or even if a single huge user of Compound were able to affect the economics of like the interest rates and how they move by moving funds around within the protocol. Is definitely something to think about as well.
Yeah, it's very funny because there's environmental aspects to it, right? So you can have all the features in place to be decentralized, but if one person holds 90% of your governance tokens, then guess what? You're not really decentralized. Sorry. So there's certainly like a gradient here that people are kind of playing with, and it's really hard to get to the point where, like Calvin said, the team gets hit by a bus and there's nobody that's there. There's like a community that's in control and not just a single person. It is a challenge.
Yeah. So thinking about Compound, Calvin, what value would you say that Compound is really creating for users?
Compound, to zoom out a little bit, you showed those sort of maps of the DeFi ecosystem basically exploding in terms of interoperability, different types of projects. I think 2.5 years ago, there were 0 DeFi products, or even things that could have been called DeFi products. Compound was one of the first. A year ago, maybe there were like 10 different DeFi products, and now there are like 50. And next year, there's going to be hundreds. So I guess what I'd say is like Compound was the first usable and useful interest rate protocol or platform on Ethereum or available that was fully on chain. So really simply for suppliers of assets, they can come in and instantly start earning interest, withdraw their assets whenever they want. It's this very flexible, secure, short-term interest rate mechanism. For borrowers, it lets them basically.
I was going to say on the supplier side, are there any specific users? Is it mostly institutions or like retail individuals?
Yeah, the supply side is very diverse because the value prop for earning interest is very simple and easy to understand. If you have assets that are sitting there earning no yield, put them in Compound and earn some yield. The value proposition to borrowers is a little bit more complex. The reason that you would want to borrow cryptocurrency has a lot to do with your personal interests, your business, what you're trying to accomplish. But what it lets you do is basically get liquidity out of assets that you're holding. All borrowing on Compound is over collateralized, so you have to put in one cryptocurrency to borrow less of a different cryptocurrency as dollar denominated. But it lets you sort of transform your balance sheet very quickly, increase the liquidity of your balance sheet. And on that side, the users are a lot more institutional. I think they're about, as sort of a rule of thumb, they're about 1/10 as many borrowers as suppliers, and they borrow, their average borrow size is about, I think, like 3 to 5x the size of the average supplier's capital.
Got it. Thanks. Yeah, so I guess moving in a bit different direction, there's a question for both of you as well. We'll start with Dan. Do you think there's an inherent trade-off between decentralization and security in contrast to, say, DeFi doing the same thing or a very similar product in the centralized traditional sense?
Yeah, so you use the word inherent, right? Which is, I don't know if it's inherent or not, but I think empirically right now, a lot of people are rushing towards decentralization and they should not be, because they're completely unprepared for the reality of what that means. They haven't thought through like all the actions that a privileged operator needs to give away. They haven't thought through how reliant the system is on oracles. They haven't thought through how they're going to do upgradability or make that big red button to pause the contract and roll back from some kind of malicious hack. So what we see right now is that there's a lot of people that just aren't doing their due diligence when it comes to building decentralized systems. And there are some people that are taking it one step at a time and carving off a single component and trying to make that decentralized while still maintaining some element of control. But people that do that are few and far between. So inherently, I don't know. It's possible that you could be more secure with a fully decentralized, operation. For instance, it's always good to have more developers reviewing your code. So an element of decentralization is like how many people can commit to the source tree of what you're building. And when you look sometimes across the blockchain space, measures of decentralization according to that metric are extraordinarily low. The core committers to Bitcoin, Ethereum, whatnot, it's like 3 people. You got to compromise one guy's machine, and then you can push out updates to the entire blockchain. So that's an area where there's a clear advantage to having a little bit more decentralization, having a flatter participation network where there's more people involved in each code change. But definitely right now, like what I see is that people that are like over leveraged a little bit on some of the decentralization stuff, and they probably should stop and think.
Yeah, Calvin, you want to add to that?
Yeah, I agree. I think maybe 2 takes on this question. The first is there are so few data points on anything that looks like true decentralization to date that it's hard even to say like whether increasing decentralization increases or decreases security, because the amount of decentralization that exists is actually not very high yet. I think at Compound we're trying to be one of the first teams that does it the best right now, but even so, it's going to be evolving for years and years. Like governance related decentralization is becomes a human problem, a political problem, a social problem, more than a technical problem. And most of these products or protocols were built initially by product and engineering people, technologists. So it's going to be evolving. I don't think governance can ever be optimized in the way that like an engineering system can be optimized. So we'll kind of have to see. Like one sort of interesting anecdote, Balancer, which I'm a huge fan of, this new exchange protocol, they recently had an incident, not a security incident, but basically a governance decision to be made. They have a governance token, but the decision was made by community members in Discord, because that's the fastest way to make the decision, because their governance system isn't really fully up and functioning yet. So you had this really important governance decision being made by emoji votes in Discord. And so, there's a long way to go from that to what you might imagine is state-of-the-art governance. But the second take I'd have on the question is basically, it depends how you define both decentralization and security. I think if you have a well-designed or ideally perfectly designed system, protocol, DeFi protocol, and there's no human in the loop, then I think that is more secure than if you have a human in the loop, like a human who can be irrational, who can be corrupted, things like that. But without a human or a centralized party, you have no recourse. And so it's not that like recourse to recover money that is lost. So I wouldn't say that like centralized systems are necessarily more secure, but to have someone to go to if they lose your money and say, give me my money or I'll, come after you in a court of law, it means like your funds are sort of more insured.
Yeah, and one, I guess, intriguing point is that, Maker, a lot of people considered Maker fairly like decentralized, and then we're still seeing like a lawsuit, right, where people are suing for funds to the Maker Foundation. So I guess it begs a question of to what extent do like exogenous, like traditional legal systems interface with DeFi like endogenous governance. And the result of that lawsuit will be interesting.
Yeah, a little bit of a different take on the same idea.
Yeah, go ahead.
You know, a lot of the decentralization stuff happens, and then you reduce your ability to react in case of failure. Right now, I think, you know, when I look across the entire ecosystem, what is the greatest risk of failure for most applications that exist on the blockchain? They are still simple coding flaws. Like, we're still at the point where we can't accurately put our ideas down to code and create a system that's reliable enough to depend on. So given that that's kind of like the most frequently exploited risk, the thing that we still can't get quite right, you need to preserve your ability to react in case of failure. And there's some people that have boxed themselves into a corner when they end up doing decentralization. The first thing they do is they start focusing on upgradability and how they're going to migrate to, you know, newer fixed versions. And they create waiting periods that are just tremendously long, where they just have to sit there and, you know, fingers crossed that nobody else is going to find the bug that they're about to patch.
So that's a great point. I guess, Calvin, I'm curious, not to put you on the spot, but how do you have a reaction to that in terms of how Compound's governance maybe finds that, because there being no fail safe anymore in Compound, right?
Yep. So we're in sort of, I think, a slightly different fortunate position where we've had a protocol up and running for basically years that has had today almost $1 billion in it, but at any given time over the past year, between 100 and $200 million of assets in it. And the core protocol is fairly simple, actually. You supply assets, other people can borrow assets. There's like an algorithm that prices the cost of borrowing and the amount of interest that suppliers earn. But there's not a whole lot of, obviously it's complex, but when you talk about, I think like Maker is more complex. BZX is much more complex. Like the core functionality of Compound, the sort of surface area of that functionality has been tested for years and is actually pretty small, pretty tight. There's not like hugely complex. There's no flash loans. There's no like, there's no auction. So we think that since it's been tested, the types of parameters that can be changed by governance are safer. Because the goal of governance is actually just to tweak parameters that are already there and have existed for years. Now, in the future, we do think that governance can get more expansive and start to make more dramatic upgrades to the protocol and its functionality. And then we hope it happens very, very slowly in the way that like Ethereum itself or Bitcoin itself evolves, where it evolves extremely slowly through a lot of debate, and changes are minor and made over time. That's what we hope to see. I think, especially with the current extreme hype around DeFi tokens and governance tokens, you're going to see and are seeing projects come out with the tokens at the same time they launch the product. When for Compound, we launched the product years ago.
That makes sense.
And to be clear, from the security guy's perspective, the approach that Compound's going through right now is definitely what we'd recommend more people do. Starting simple and iterating on the decentralization leads to a much better result.
That's great. Thinking about mechanisms being intertwined with other mechanisms in DeFi, do you guys think that this poses a lot of risks of like spillover damage, where something can happen in one protocol and then that ripples through in unexpected ways? And how can individual projects take into account all of these interactions, some of which they don't even have control over themselves, right? We can start with Dan.
Sure. So I think that as you're building these DeFi applications, and this goes back to kind of the people doing their diligence to make sure that what they're doing is safe, can be relied upon, exhibits kind of behaviors they expect, you should be whitelisting a lot of your external interactions early on. there is no reason that your DeFi protocol needs to accept arbitrary ERC20 tokens. And if you do, you need to take a lot of precautions to make sure that what you're getting is something you know how to deal with. There's a lot of non-compliant, kind of like, you know, all these projects out in the space can behave any way they feel like. And you kind of have to know all the little nooks and crannies of the odd behaviors of each of them when you interact with them. You know, whitelisting is a really easy way to you know, start taking some steps there, gain some familiarity with like what could happen. Yeah, so from a recommendation perspective, I guess I'm just assuming the question is true, that yes, there is risk in composability. There are emergent behaviors that show up, and you should do what you can to limit your exposure to those issues by carefully considering what you interact with.
Yeah, it's scary. Obviously, I think like it's for Compound, the way in which we've thought about interoperability with other DeFi protocols or products is we've been extremely conservative about it. Almost everything, except for obviously the tokens that are supported in the Compound protocol as markets, was built kind of in-house. Like there's very little external dependency. Even the assets that we add to the protocol have been added extremely slowly over time. 2 years ago, there were 5 or 6, and today there's 9. So, you know, every asset that gets added goes through a very, very rigorous assessment. Audits, each asset is audited independently. But becoming more and more connected to other DeFi protocols is part of the point. So it's going to happen. It just needs to happen safely. And it's interesting because from a Compound perspective, you know, I hope the protocol stays very conservative and only sort of gets tied into very safe protocols, because yeah, there's a lot of spillover effect and it looks really bad for the entire DeFi ecosystem. If there's any sort of exploit to any single project, and now they're more and more connected. You know, from a personal sort of, as a user of these products, some of the interactions that are happening between protocols, I just like, it's impossible to quantify the level of risk that like a user is taking, that I'm taking really. And, you know, you just kind of hope it's not too high, because that risk is also, being early to these products is also usually rewarding.
Yeah, on that note, would you say you believe Compound is now at the stage where you would recommend it as safe for retail investors who are not looking at the code themselves?
Yeah, you know, not speaking for the company or the protocol, I would say yes. I mean, and that's for me as an individual. I use Compound because we've had at this point like 12 security audits, many done by Trail of Bits. We've had sort of economic type of audits, and there's basically been $100 to $200 million in it for over a year, and that's a pretty big sort of bug bounty itself. Yeah.
Cool. So thinking in a bit different direction about the technical and economic elements being interlinked, I guess starting with Dan, how have you seen that play out in DeFi projects you've worked with, where there's an issue in a technical side, on the technical side, that then directly affects some sort of incentives, and then maybe a feedback loop where this causes something else on the technical side?
I mean, are you trying to lead me into talking about flash loans? So, I mean, just a little tangent there. Yeah, like the flash loan thing is totally insane. Like as a security expert in the space, a lot of times you're calibrating the security of a protocol based on the economics of it. And there might be, for instance, some kind of attack that we identify that's possible by manipulating an oracle. And then we say, okay, well, that's not a big issue because it'll take somebody $10 million of their own money to pull off manipulation at that scale to affect the bug in your system. So that's kind of a safety margin. It's extremely high difficulty. You know, it might be high severity, but it's less likely that somebody can exploit it. But with this flash loan thing now, you know, anybody can be a, you know, 15-minute millionaire. And the margin of error that people have when they're developing DeFi projects is extraordinarily lower. So the need to kind of consider all these possible economic attacks and the ways that particularly oracles are kind of interfacing with your security is much greater than it was a year ago.
Yeah. Yeah, Calvin, do you want to add something there?
My reaction also kind of goes towards mainly oracles, and you might think if you're just building a DeFi product from scratch, oh, I need prices. Prices are easy. Like anytime I, as a user, want to look at prices, I just go to CoinMarketCap or CoinGecko or just Google it, and it's easy.
Yep.
But you have to make them available on chain in a secure way is way more difficult, obviously, and most sort of retail or individual users probably don't understand the stack of an oracle, like what goes on behind the scenes, what the sources of the oracle are, how prices are served, whether there are rules around how prices are served if they go haywire. And that's obviously both kind of a technical problem. There are trade-offs in choosing how you oracleize or access your prices. I'll sort of give a shout out to one thing Compound is working on, the open oracle system that Coinbase is contributing prices to, and we're hopeful other large sources of liquidity will contribute prices to, but basically posting prices on chain to one big repository of price feeds, and then letting users or developers decide which of those price feeds they want to access for their products.
I see. So you're saying that as an approach to like the Pegnet I alluded to, where it's just purely like based on the top 35 out of 50 bids, you throw out the ends. You think what you just described is better than that?
Yeah, I think what we're hoping it becomes is basically like a repository where you as a developer can go in and see like, okay, Coinbase signed this price feed, and I can check with Coinbase and see that this is their price feed. OKX or OKCoin did this one. I'll use Coinbase's in this case, but not OKX's in this case. Or I'll choose to toss out the bottom 10 or whatever. Interesting.
That seems like it could present some other new issues as well, but it's definitely different. How I guess, talking about incentive compatibility, how has Compound thought about getting incentive compatibility right on mechanisms like how interest rates fluctuate for borrowers and lenders?
Yeah, there's one thing I don't know if I've voiced much before, but that I feel lucky about in Compound versus Maker. The systems are kind of similar in concept. In terms of, in Maker, you put in a number of assets and you get out DAI. In Compound, you put in a number of assets and you get out any of those assets. So one thing that's very difficult for Maker though is they have to make sure that DAI stays pegged to around $1. And that depends on a market that's outside of their control. That happens on exchanges that they don't control. So sort of, they have to control these levers in here to optimize for the price of that perfectly. In Compound, even if our interest rates algorithms are set suboptimally, they still work. The protocol itself might not be optimized for maximum usefulness or usage, depending on how even you want to define that, which is itself its own question, but it remains safe for users. When you talk about the interest rate algorithm, for example, perhaps it's set too high, and that means users aren't borrowing, and so the economics of the protocol could be more efficient, but that still doesn't present a danger, and the thing is still usable. We don't have to like optimize every lever to be perfect. So that's sort of a long way of saying, they probably aren't perfect today, but what our goals are, first and foremost, are always the safety of user funds. And then beyond that, now it's up to governments to figure out, basically to define what they think is optimal in terms of like interest rate algorithms, collateral factors, things like that, and then change them in the direction that they want to see.
Got it. Yeah, Dan, did you have anything else there that you wanted to add or no, in addition to what you said before?
You know, I mean, when we look at a lot of DeFi applications, I think there are some really common classes of things that go wrong. So as we're kind of running out of the end of the hour here, I wanted to offer some tips for ways that people can do the right thing more often. You know, I think a lot of people sit down and spec out their DeFi system on paper before they convert it to code, but that conversion process is extraordinarily difficult. There can even be like really minor things, like maybe you use safe math everywhere, but safe math isn't always going to prevent you from running into rounding errors. Arithmetic is extraordinarily more complicated than it needs to be in Solidity and on the blockchain. And we see a lot of incorrect formulas and rounding issues and those sorts of things in projects that we look at. You know, the external interactions I went through, when people start interacting with random other DeFi systems, there's a lot of inconsistencies in what you get when you get a token, right? Some of them can migrate. Some of them can re-enter. Some of them have all kinds of decimal values. And you need to be prepared to understand what those are before interacting with some random system. There might be unexpected arbitrage opportunities too, right? Trusting your oracles. We find a lot of systems misplace trust in the oracles that they work with in ways that sabotage their own security. And then a lot of people, when they spec out something on paper, they don't consider the front-running risk. They just consider that all these transactions get played out sequentially and that there's no way that anybody could reorder them. You know, some things to think about as you're building a DeFi system. We do have some lessons learned that we've collected in a resource called Building Secure Contracts. It's up on our GitHub. I'll put a link in the chat. But I do think there needs to be a lot more focus on security from the beginning, early on in the process, when people are building these really complex systems that directly manipulate financial value. So, you know,
yeah, all good points.
Consider some of those things.
Yeah, with now we have the last 10 minutes, we're going to shift to some audience questions that have been coming in. And I know 10 minutes is not a whole lot, but it's still exciting to do. The first one appears to be aimed towards Calvin, and it is, there are varying reports on the level of success for Comp's launch, the governance token that Calvin had referred to. With that being said, all groundbreaking events will experience hiccups. What have you learned in terms of the economic or technical security that you say that a next network could learn from as other networks move towards, you know, the decentralized governance side?
Yeah, it's obviously a great question, probably the most interesting question for Compound Labs Inc. now, as we basically watch as the protocol is taken over by token holders. And I'm not sure we have an answer yet. Like I sort of alluded to before, governance, at least as I think about it, is as much a human problem as an engineering or system design problem. What would I describe? You know, I definitely think things went more right than wrong. I actually don't think there are any critical sort of flaws. I think usage of the protocol increased. Interest in the protocol increased. One interesting thing is a lot of huge whales came into the protocol as users to try to accrue the comp token because it's distributed to users on a block by block basis. If you come in and use compound for a block, you receive comp, you accrue comp immediately. So, you know, that has a lot of sort of second order effects. It will influence governance farther down the line once the users accumulate a lot of comp. It also impacts sort of like the value of comp as valued on external venues, on exchanges, which feeds back into impacting the economics of the protocol for users. So I don't really have a good answer of like things to look out for yet. I think there's still a lot of lessons to be learned. It's too early to say what's working or what's not.
No, yeah, all good points. On the, I guess the point you mentioned where you've seen, assets on Compound have skyrocketed, and I think even Robert mentioned that, a lot of this is maybe inorganic or artificial, people leveraging multiple times this kind of circularity sense. Do you personally, I guess, not see, personally, do you not see any real issue with that? Like, would you consider that honest usage of the platform?
Yeah, there's an issue there. So the design of the comp distribution to users was intended to, first of all, intended to be upgradable over time through the governance system itself, which is happening already very, very quickly within a week of the comp distribution starting and people seeing this type of activity. What we wanted to do was basically have the token be distributed to users based on the economic value they created for the protocol and other users. So, the formula that was implemented was an attempt at that, and it definitely needs to be perfected over time. And I think it may always need to be slightly upgraded as the protocol itself changes, as DeFi changes, as crypto changes. It's sort of everything's always changing. So, it may itself need to continue to be upgraded.
Got it. Yeah, thanks. Next question, I guess, for Dan. What do you see, or what do you believe teams can do themselves to cover some of the crypto economic gaps that sit between technical and economic realms?
Yeah, sure. I mean, I think this goes back to the standard guidance that we give every project writing a smart contract, which is that you should have a spec. You should convert that spec into something that can be ingested programmatically, and then you should use that programmatic spec to automatically generate test cases. Like, too few people have a solid understanding of exactly what's expected of the code they write, and then far fewer people have a programmatic verification that that is actually true. A lot of people just sit down and start YOLOing a bunch of code. They say, hey, I want to start doing this loan thing. This is my best guess at what it looks like. Okay, I wrote some unit tests. This is cool now, right? Like, now I can go pay an auditor to go look at it. And that is just not the way that you should be working. The number of people that sit down and actually spec it out on paper first is just even too limited by itself. We have that Building Secure Contracts guide that walks through some of the ways that we recommend people build software so that it ends up in a place that's high assurance. But I think one of the big takeaways there is that it's never too soon to speak to a security expert. There are a lot of mistakes that you can make early on in the process that you just build on top of, and that ultimately design an insecurable system at the end. So the earlier that you speak to somebody that knows, what behaviors lead to insecurity, the earlier you can avoid those foot guns and those dangerous sharp corners, and end up building a system that's a little bit more simple and a little bit more trustable and a little bit more testable, so that ultimately when you actually deploy it to the blockchain, you have assurance that it works correctly.
No, that's definitely great to hear. And one thing that popped in my mind when you said that was that at Prysm Group, we would also echo that you can't really get all the technical elements right along and then just slap a token on at the end, right? And be like, oh, we're just going to add this on, and we assume that the economic side is, completely separate from the technical. So we would echo that early on. You should start, prioritizing the economic security elements too, because this stuff is not all going to automatically come together at the end.
Yep, 100%.
Yeah.
I want to add one quick note, which is basically for Compound has shipped like 4 things in 2.5 years. The pace of shipping, the way things are kind of built at Compound is there's literally 1 to 2 months of basically spec design and starting to do this type of testing, system design, producing MVPs, alphas, and then there's 2 to 3 months of actual development towards a production ready product or upgrade to the protocol, and then there's a month or 2 of audits. Like, the pace is extremely slow. You can't rush it. 2.5 years, we basically shipped version 1 of Compound, version 2 of Compound, governance, a token, and that's it. So we haven't gone fast.
Got it. And yeah, and what I'm hearing is that you're saying, yeah, DeFi is not, move fast, break things, right? When like trust is compromised like immediately, right? If something bad happens.
Please no, yeah. I mean,
Yeah.
the really weird thing about the whole DeFi space and the whole blockchain space in particular is your failures are public. Like you might be able to get away with a traditional company just sending out some kind of credit notification letter to a couple of people and maybe it doesn't hit the news. But in this case, your failure is right out there on Etherscan. Sorry about it.
Yeah. Also, I know we only have 3 minutes left, and there's one pretty deep, good question I wanted to try to get to. So someone's curious about thoughts on less than fully collateralized loans. And they say right now everything is over collateralized or fully backed, which has somewhat limited use cases in terms of real utility. How do we as an ecosystem get to a point where credit can be extended on chain? And what requirements would there be for borrowers, protections for lenders in this case? Is there a way to do it without just copying and pasting traditional methods such as a credit score? Or are we bound to simply kind of recreate traditional markets on chain because they're already battle tested and they already work? And if that's the case, then what is the value add of DeFi? So a lot of layered questions there. If anything comes to mind, yeah, jump in.
I'm not touching that one.
Sure. So I and Compound Labs definitely don't have the answer today, but we are thinking about that a lot. So we consider basically this over-collateralized compound protocol to be out of our hands at this point. We obviously will participate as individuals in the governance around the protocol, but it's up to the community and comp token holders. However, what's next for Compound Labs? We do want to work on those types of problems. And the way that we think about it at a really high level is basically you're starting to see Bitcoin come onto Ethereum. So these are different ways of representing an asset that is off-chain of Ethereum onto Ethereum. Is there perhaps an approach where you could generalize that? Start with Bitcoin, but could you generalize that to other off-chain assets? Could you generalize it to assets that aren't on blockchains? Maybe it's like the next step. And then could you generalize it to assets that aren't even tangible, like reputation or credit score or something like that? So I think that's a sequence that we're thinking through, and it's something we want to work on. It will take a long time for us to work on and develop something that sort of attacks that problem effectively, but it is, I think, not a holy grail, but like a big goal for DeFi, and I think we want to help get there.
Cool. Well, yeah, now that I see we're at exactly time, I guess we can conclude by saying, do you guys have any spaces or things you want to say where people can learn more about these concepts and the things we've discussed?
Yeah, absolutely. If you're building a DeFi application, you should consider first building secure contracts, which is our open GitHub repository that walks people through best practices, including using advanced analysis tools to get that assurance that your code works the way it should. We also have office hours, where if you go to the awesome Ethereum security GitHub, which is another one of ours, you can book time on my calendar directly, and I'll have somebody from TrailBits talk to you for an hour. Just out of the goodness of our hearts. we really want to help people make good decisions, so we try to be as open as we can. Those are the 2 things that I recommend, and I'll paste a link in the chat.
Awesome.
If you want to learn about Compound, go to compound.finance, click around, links to our blog, our security page, and audits. If you want to talk with the team in our community, go to compound.finance/discord in our Discord. And feel free to email me at calvin@compound.finance to discuss any other topics.
Awesome. Well, yeah, thank you guys so much again for taking the time. Really appreciate it.
Thank you.
Yeah, thanks for having us.
Bye.
Take care.
Bye.
Bye.